Okay, so it's more than a week. So let's have a quick recap. We're in the middle of chapter 20, accounting for lease. So far we covered 3 topics. We introduced the lease environment. We talked about its lessor's role to set rent, lease payments to recover their investment. And we talked about lease accounting for leasee under IFRS, which is a right of use approach. So if a contract conveys the right of use a identified property from from one party to the other party for consideration, then it's a lease. Most leases are capitalized, with the 2 exceptions: short-term and low value. So basically anything that's significant material will be capitalized. And that's a new lease accounting standard became effective 2019. At a minimum, we're going to cover the lease accounting under ASPE. And it serves 2 purposes. One is just now the lease is treated differently under ASPE and under IFRS. And secondly, the ASPE approach is the old IFRS approach before IFRS 16. So by examining the accounting standard under ASPE, they will also emphasize the significance of the change. So that's our first goal. And then we will go over an example that contrasts the 2, the IFRS and ASPE for leasing. And the last one I hope I will get to talk about is the residual value, the treatment of the residual value. So that's today's plan. Okay, so I'm going too fast. Where it is. Okay, so here it is. Yeah, accounting for leasee under ASPE. So remember, just to refresh you, under IFRS, it's if a contract contains lease, then it's a lease contract. All lease contracts except the short-term and low value are capitalized. That's a nutshell, right? That's called the right of use approach. Under ASPE, the approach is called the classification approach. Okay, so the lease is classified as either an operating lease or a finance lease or capital lease. The term changed here. When you hear the term capital lease and the finance lease, they're the same thing. Okay, now the classification is done according to 3 criteria. Okay, the first one is transfer of ownership. Who gets to keep the equipment, the property at the end? If the leasee gets to keep the equipment at the end, then it's a capital lease. If lesser, then it's operating lease, right? So the transfer of ownership can be in one of the 2 ways. One is you just leasee just get to keep it. Like by the end of it, leasee gets to keep it for no considerations. The second one would be if there is a purchase option and this purchase price in this purchase option is significantly lower than the fair price. So we call it ASPE. Under ASPE, it's called a bargain purchase option. So the idea is we're a rational person, and if you have a bargain, you take it, right? So if there's a bargain purchase option, we consider that ownership will transfer. So if the ownership will transfer, then it will be capital lease because it will be similar to installment purchase. You make lease payments, by the end of it, you own it. It's very similar to installment purchase. If not, then it's operating lease. The second one is economic life test.
Did the place send you any pictures yet?
Oh, sorry, pardon? What's the question? You're not seeing the slides? I think it's sharing. Let me just refresh it to see if that make any difference, okay? I did not want to hear. It could be something different altogether. Okay. Okay, awesome. So that's it. The second one is economic life test. Compare the lease term with the economic life of the property. If the lease term is 75% or more of the economic life, then it's capital lease. Otherwise, it's operating lease. So the idea, if you lease the most useful life of the property is, for most part of the property's useful life, it was leased. So then leasee would pretty much enjoyed all the benefits of this property, significant, substantially significant of that, right? So the lease is substantial. If it's substantial enough, the lease term is 75% of the property's economic life or more, then we consider it's similar to a installment purchase. So it's capital lease. Otherwise, it will be considered operating lease. The last one is recovery of investment for lesser test. So if the present value of minimum lease payments is 90% or more of the fair value of the property, right? So that means if lesser recovers the investment significantly from the lease, then it's capital lease. Otherwise, it's operating lease. Okay. Now, what do we mean by minimum lease payments? Because this is the term used under ASPE, and it's not exactly an intuitive minimum lease payment. So that's talk a little bit about these three things. So minimum lease payment is just the lease payment that's not cancelable. Okay, like you committed to make. Okay, it's different from executory costs. Executory cost is the cost associated with the ownership cost associated with using the equipment. So example of that would be insurance, tax, maintenance. Okay, so these are can be paid by both, either lessee or lessor or both. And usually these are considered operating cash expense. Whoever pays it will expense it. And then there is a matter of discount rate, right? The present value of future lease payments. So we need to know a discount rate. We already talked about discount rate, which is called the lessor's rate or implied rate. So that's the rate of expected return on lessor's investment. That's the rate the lessor uses to set rent. That may not be known to lessee. Okay, so lessee may be informed or somehow just know lessor's rate, may not. Lessor is not obligated to tell them. So under ASPE, if you do not know lessor's rate, you don't have choice. If you do know lessor's rate, you use the less of the two. That's different from the IFRS. Remember, IFRS is if you don't know, you have to use your incremental borrowing rate. But if you do know lessor's rate, you have to use lessor's rate, regardless which one is higher, which one is lower. Okay. So minimum lease payments include the rent and the amount guaranteed. Okay, so if the property is returned to lessor at the end of the term, we'll talk more about these residual value later on, but at this point, just enough to finish this part. So when it's returned, you have to estimate the residual value, and the residual value can be guaranteed or unguaranteed. So what does that mean is if the guaranteed and when the property is returned, the actual value is lower than the guaranteed value, lessee has to pay. If the residual value is not guaranteed, doesn't matter. We know that, like when that's one of the disadvantage of leasing a car, right? When you lease a car, sometimes you limit mileage, limit the condition of this, how much you can use, what's the value of the car. And if you exceed that limit, means you use too much, reduce the fair value of the property, that car, there is a payment you have to make, right? So that's when the residual value is guaranteed. Okay, so if the residual value is guaranteed, that should be included in the minimum lease payments. And if there is a purchase option and the purchase price is lower than the fair value, so with the purchase option is considered a bargain purchase option, that should also be included in the present value calculation. Note, these two do not exist same time, right? Because if there is guaranteed residual value, that means the asset will be returned to lessor. If there's a bargain purchase option, that means we assume lessee will keep the asset at the end. You either return it or you keep it. You can't do both at the same time. So either one, if it exists, should be included, and you don't have the situation that both exist. Executory cost will be expensed, as we said. Okay, so the discount rate, we'll talk about that. And a little explanation, as we specify the lower of the two rates to be used, and that is for because the lower the discount rate, the higher the present value, right? And the present value, if it exceeds 90%, it's capitalized. And by requiring lessee to use the lower of two, we prevent the situation where lessee will just arbitrarily choose to say our incremental borrowing rate is high, so therefore you can discount more, so you can just miss this 90% mark, and then to avoid capitalizing the lease. So that's the idea. Okay, now I would just mention a little bit. Now the criticism of this lease accounting standard is you have 3 criteria, so you do not have to meet all 3. If you meet 1, you capitalize. You know, you don't have to meet all 3. If present value is more than 90%, that's sufficient. Only need 1. However, because they are black and white, clear cut, so if say 90% or more, it's capital lease, 89% is not. 75% or more useful life, that's capital lease, 74% it's not, right? So because the rule is clear, if a lessee is very motivated to keep the lease off balance sheet, you can work out the term to circumvent this requirement. And that is what happened. Like lots of empirical evidence shows that's exactly what happened, right? So that's the criticism of that. Okay, so let's look at this example. So let's assume, and this lease is very similar to most retailers lease with their landlords. Okay, lots of retailers rent their store space and lease is fairly long, but not long enough to be considered a capital lease under SB. So let's say a leasee rented a unit number 13 in East End Shopping Mall, right? Let's assume the economic life of the property at the mall is 35 years and this vendor's lease is 10 years. A title to the lease equipment will be retained by the lessor, obviously, you know, a lessor is the landlord. And let's assume like a 9% discount rate, annual lease payment, 15,000 at the beginning of each year, fair value of the unit is 240,000. So this will be very typical for retail lease with the landlord, right? So we apply those three criteria. First of all, property reverts back to the lessor at the end of the lease. So there's no transfer of the ownership, okay? And the second one, the lease term is 10 years, economic life 35 years. So that's only 29% of the economic life, far less than 75%. So that's operating lease. Present value of lease payments. So if we discount this 15,000 annuity due at 9% over 10 years, we get 104,929. Okay, so just take my word for it. You can try it later. That's over 240,000. The fair value, 44%. So that's less than 90%. So all three criteria says, well, it missed the mark, so it's operating lease. So nothing needs to be on the balance sheet, not capitalized. So the lease's accounting is every year, it will record the rental expense, 15,000. Okay, nothing on the balance sheet. So this is the off balance sheet financing at work, right? Now, so we know this lease under IFRS would have to be capitalized because it's not short term, it's not low value, it's a specified unit number 13 in the mall, that's identifiable asset. So it's a lease and it will be capitalized. Okay, so there are quite a lot of research show that for instance, Dollarama, yeah, Dollarama, it's the store, their assets liability doubled as a result of implementation of IFRS 16, because like they have their stores in the shopping malls, in strip malls, and then they are all on the lease. And so lease are be similar to this, and before IFRS 16, they were all off balance sheet. Now they have to bring it on the balance sheet. So there's a huge liability, huge assets. Okay, so now that's just a contrast the IFRS 16 and ASPE's accounting for leasing. Okay, let's contrast that. So these are the informations about the lease. So a contract cost for lessor corporation to lease equipment to leasee corporation beginning January 1st, 2020. The lease term is 5 years. The lease agreement is non-cancelable and it requires equal rent payments of $25,981.62 at the beginning of each year. So this will be annuity due. The lease beginning January 1st, 2020. The lease contains no renewal options and the equipment reverts to lessor corporation at the end of the lease. So if there is a renewal option and if it's more likely, we expect the renewal option to be exercised, we have to include those terms as well, as our first example showed from last week, no, from 2 weeks ago. The equipment has a fair value of 100,000 on January 1st, 2020, an estimated economic life of 5 years. We know it's capital lease already, right? For under ASPE, because economic life and the lease term is the same, 100%. So that's, we don't even have to do anything. One is enough. No residual value. Lessee Corporation uses straight line depreciation for similar equipment that it owns. Lessee Corporation pays all executory costs directly to third parties, except for maintenance fees of $2,000 per year. So lessee would pay for insurance, for instance, but it's directly paid for insurance company. But for the maintenance, this fee will go to lessor. You know, they can arrange it anyway, but that's just show how that works, which included an annual lease payment to lessor company. So that means this 25,982, that includes this 2,000 maintenance fees. So when we compute the present value, we need to subtract that 2,000 from that 25 to 81.62. Okay, so that's that. Lessee Corporation's incremental borrowing rate is 10% per year. Lessor Corporation sets annual rent to earn a rate of return on its investment of 10% per year. This fact is known to lessee. Okay, so there are two rates. Lessor rate is 10%, lessee rate is 11%. So which rate should the lessee use? And the IFRS? What's the rule under IFRS? If you know lessor's rate, you use lessor's rate, right? So it's 10%. What about under ASPE? Rules are different. The lower of the two, but the outcome is the same in this case because lesser rate is lower, right? Okay, so that's that. Lease meets at least one of the criteria for classification as capital lease, so as under ASPE. The 75% lease term threshold is met. So that means the benefit of the property is mostly enjoyed by lessee, right? Like similar, like an owner would do. Present value of minimum lease payment is 100,000. So if you discount that's 23,982 at 10% over 5 years, you get 100,000. You can verify this, but your calculation would confirm that exceeds 90%. Don't need both. One is due. And also, we didn't mention here, the property will go back to the, that doesn't matter. Lease is set up as a right of, under IFRS, it is right of use lease, right? It's a conveyed use of a specific asset for considerations. So capitalization under both IFRS and the ASPE, and since they use the same discount rate, the computation will be the same. On the Brightspace, I was uploading, I have the amortization table, but I'm not sure it's gone through because just when I was uploading it, my internet service was interrupted and I meant to check, but I have not, but I will check it afterwards. So I have the amortization table there, but for answer this question, we don't really need the amortization table. Okay, so if we accept that the present value of annual lease payment at 23,982 discounted at 10% over 5 years is 100. Okay, so journal entry will be this very similar. We debit an asset, credited liability. This liability should be the same amount, but since the first payment is immediate, so the liability is the difference between the total amount capitalized and the payment. Okay, now the difference is the title of the account. the title of account. Under IFRS, the asset we debited called the right of use asset. The word lease is not in it, just right of use asset. And the liability is called the lease liability. Okay, under ASPE, the asset is called equipment under lease or leased assets. And the liability is called obligation under lease. Okay, obligation under lease. Yeah, so like lots of parts between IFRS and ASPE, the terminology is different. Like in the tax, we talk about deferred tax is deferred, word deferred is used in IFRS and the future is used under ASPE, right? Journal entry to record the exactory cost and the first lease payment on January. So first lease payment is included in here, and exactory cost, the part that not paid independently to the third party, the part between lessee and lessor would be, this would be lessee. The amount is paid to lessor, but the lessee records debit operating expense. So that since we were told specifically that's maintenance, so maintenance and repair expense. Okay, now if this is paid at the beginning of the year, they didn't say when, we can first debit prepaid expense and subsequently adjust that. We can also debit directly. Okay, so that's you know, at the beginning of the year and the first the payment for exactory cost. Year-end adjustment, first year. Interest needs to be accrued because let's assume December 31st year end. So 1 year interest needs to be accrued. The payment is next day. So the amortization table for annuity due, we need to remember the interest is based on the remaining liability balance. That's the difference between 100,000 and 23,982. So that's the carrying amount of the liability, and 10% of that is 7602. So it's interest expense is the same, and the lease liability for IFRS, obligation under lease for ASPE. In addition to that, the capitalized asset, either right of use assets or asset under lease, needs to be depreciated using the straight line, so that over 5 years, no residual value with a capitalized amount of 100,000, that's 20,000 a year. So we debit depreciation expense, credit accumulated depreciation. Okay, so that's the first year. After first year, you carry on, the assets will be depreciated continuously using the straight line. The liability would be amortized using the effective interest method, right? Yeah, so we're not going further. So accounting for residual value. So the residual value is, well, this will be relevant if the asset is returned to lessor at the end of the lease. Okay, if the residual value is guaranteed, that means lessee agrees to pay for any loss in value below a stated amount at the end of the lease. Okay, so if residual value says 10,000, there's a possibility if the value is less than 10,000, the lessee will have to pay for the difference. If it's over 10,000, you don't, it's okay. Okay. If the residual value, since this residual value is guaranteed, that could mean the leasee could potentially have to pay maximum the entire residual value, right? That's the maximum amount leasee could be required to pay. That means if the residual value is 0, leasee have to pay the whole amount. So leasee need to take a consideration of this guaranteed residual value, okay? Because that could be real obligation. In the example we are going to show subsequently, the leasee goes very conservatively, capitalize the entire guaranteed residual value, okay? But knowing that could be less than. If the residual value included is unguaranteed, then leasee has no responsibility or obligation for assets condition, right? Whatever the shape it is, you return it, you're done. So therefore, unguaranteed residual value is excluded from the present value of lease payments by leasee, the capitalized amount. Lesser, see, these are a lot of details. Lesser include residual value in determining lease payments, regardless whether the residual value is guaranteed or not. Okay, so lesser will always. So here's the example. So lesser wants to recover net investment of 100,000 and earns 10%. Asset reverts to lesser at the end of 5-year lease term. Expected residual value, expected but not guaranteed. Expected residual value at the end of lease is 5,000. So lesser will consider this residual value in their calculation. Doesn't matter it's guaranteed or not, right? So since there is a residual value and the present value of that residual value is at the 10%, 5 years is $3,105. So the present value of the lease payment only needs to be $96,895. Okay, so that means lesser is not expect to recover all its investment from lease payments. Small part of that investment will be recovered by the residual value. Okay, so the rent is $23,237. So it's slightly less than if there's no residual value. Okay, like the example we just see, there's a slight difference. So less is less. So that's from lesser's perspective. From leasee's perspective, now leasee need to know whether this residual value is guaranteed or not. The accounting for that is different. So if the residual value is guaranteed, if the residual, so it looks very same, but they're not same thing. So this word calculated is the leasee's capitalized amount. If the residual value is guaranteed, then both the residual value and the lease payment will be capitalized. When you discount the residual value and the lease payment, you also got 100,000. Okay, in this case. Okay. However, if residual value is unguaranteed, now this here is like we're showing pretty much both. So the term is a bit different. Under ASPE, it says the residual value is if it's unguaranteed, and IFRS, it's residual value not expected to be payable by leasee. That's the IFRS value, IFRS way to say that's not guaranteed. In that case, IFRS leasee's obligation is only the lease payment. Okay, so the amount to capitalize will be only the 5 lease payment. So the amount will be $96,895. That's difference, right? So keep that in consideration. You see, it's like things will be different because of that from the start of this. On January 1st, that's the commencement of the lease and the first lease payment. If the lease residual value is guaranteed, the amount capitalized the asset is 100,000. The term used is SB's term. And we still assume that the 2,000 executory cost will be paid by lessee to lessor. So we'll put it here. You see, this is 25. We add 2,000 here, right? So subtract the amount paid. So capitalized amount is set 76,763. If the residual value is not guaranteed, the amount to be capitalized is 96,895. With present value of residual value is not included. So the liability will be less too. Because of that, the interest will be different because the liability balance is different. Okay, right? So, but effective interest method is used regardless. So interest expense is debited and then lease liability is credit, or obligation under lease is credit. It's also different. Okay, if with the residual value guaranteed, the depreciation amount is 19,000. That's 100,000 minus 5,000 divided by 5. Unguaranteed, there's no residual value is not there. So we just divided 96,895 by 5. That's it. Okay. So if you keep doing that, okay, let's go. Yeah. This, we go to the second year. The second payment, it's same to the first payment. Payment is 25 to 37. 2,000 of that is the executory cost, and the remainder part is the reduction of liability. So if we do that to 5 years, okay, do that to 5 years, the lease liability by the end of the 5th year, if the residual value is guaranteed, you will have a liability of 5,000 left, right? They will have the liability of 5,000 left. And the asset, the cumulative depreciation will be $5,000 less than the leased assets. Okay, so let's assume that the asset was depreciated down to its residual value 5,000, but the fair value at the lease end was only 3,000. So the fair value is below the guaranteed residual value, or below the residual value. So if it's guaranteed, then lessee needs to pay $2,000 difference. So the lessee's journal entry will be this. So this is include everything. We removed equipment under lease. We remove the accumulated depreciation. So that's a 5,000 difference. And then we remove the remaining balance of obligation under lease, that's liability 5,000. So this did that. So that we return the lease. However, because the fair value of the lease is below the guaranteed residual value by 2,000, lessee needs to pay 2,000. And that 2,000 is the loss. Okay, that's 2,000 is loss. So that's it. Now, if the residual value is unguaranteed, the liability is already gone, right? So leasing needs to return the assets and remove it from its balance sheet. So all they need to do is to cancel this each out. Doesn't change anything because this already canceled out, but now you just do remove it completely. Okay, so that's about that. Now, so that I cover that. So I have one more class, so leave that lesser accounting for lease for next class. So I will show you the amortization table. And okay, let me see. That's not amortization. That's not the amortization table I have. Bear with me. I'm going to get it. I'm going to get it from my. What's my password? Okay. Which one is that? I think that's one. Let's hope it's that one. Okay, that would do. So here I have it. No. That's not the one. That's not one. Let me try another one. Oh, which one did I download? Ah, this is the one. This is the one. Okay. So the example included these two, right? So like this one is it's a different, it's assumed that if there's no residual value, you see the lease will be a little bit higher than this one we did a reason. So 23,237, and without the residual value is 23,982, right? So just show for the lesser without the residual value, the rental will have to be higher. With the residual value, regardless it's guaranteed or not, the rent will be lowered. Okay, and so these are the two examples we contrasted. That's so if the residual value is unguaranteed, the amount capitalized is 96,985. Only the lease payment, right? Without the residual. And so at the end of the first payment, this is all happened the January 1st, 2020, the lease obligation will be 73,658. Okay, remember that I showed you two amortization table, like one just the standard amortization table the textbook used, and another one I inserted additional explanation because this table can be confusing. So here's the interest 7366 is paid on January 1st, 2021, but that interest is actually January 20th interest, right? That amount is based on this balance. So this amount, let me okay. So this amount, you see the calculation is based on this balance, E6, right? So this amount is based on this balance. So that's a balance start January 1st, 2020. And over a period of 1 year from January 1st, 2020 to December 31st, 2020, 10%, 7366, round up to the dollar, interest is accrued on this amount. And this amount is deducted from the payment made on the January 1st on 2021 to determine the reduction of lease liability, right? So on this table, so this amount is actually the interest of 2020, okay? And this is the beginning balance of 2020. The balance, the liability balance.
Professor?
December 31st.
Professor?
Yes?
You are not sharing your screen with us.
Sorry.
No.
Let me share it. Here it is. Sorry. Okay. I guess you guys were looking at the slide. So let me just recap that. The first amortization schedule is for the residual value that's unguaranteed scenario. If the residual value 5,000 is unguaranteed, leasee only capitalize the lease payment. So this amount is the present value of lease payment of 23,237 only. Okay, there's no 5,000 residual value. So that's why it's less than 100,000. And this amortization table, to read it, this is the balance at the end of the first day's transaction, after the lease is capitalized, after first the payment is made and recorded. The row of 2020 show no interest because the interest is here. Interest is in this row labeled January 1st, 2021, because we considered 2020's interest is paid in January 1st, 2021. So that's why this table is not that expressive, right? So this is interest expense for 2020, but is shown here as part of the payment of 2021. And the liability balance on December 31st of 2020, that's where we need to show on the balance sheet. It's not even on this table because this liability here should be 73,658 plus the interest accrued during the year. That's a $70,366, right? So that's the balance. If we want to take it a step further, out of this amount, out of that amount, 23,237 is current, and the remaining part is non-current. Okay, so what is that? Just write it out. So that's the liability on December 31st, 2020, okay? And so also let me take it a step further, of which 23,237 is current, okay? And the remaining 57,787 is non-current. Right? So when you look at the financial statement, you see the current portion of the lease payments, non-current portion of lease liability, you know what they represent, okay? So because there is a payment due the next day, so that amount is current, and the amount is not due within 1 year is the 57, but you can tell that's still outstanding after the payment, right? And then and then no payment will be made throughout this year after the payment of January 1st. So that's that. And at the end of the year 4, the balance is 20. Well, at the end of the year 4, this is the beginning of the year 4, the balance 21,124, and at the end of the year 4, so liability balance on December 31st, 2023 is what? Is 21,124 plus 2,112. So that happens to be 236. It's $1 rounding error, right? It should be like, so that means the next day when this payment is made at the beginning of the last year, there will be no obligation left, right? So that's that. Okay, so here we get another go of this amortization table. Now, this one is different from those basic table. Has a residual value, and the residual value is guaranteed. And so from lease's perspective, this amount capitalized include both the lease payment and the present value of the residual value. It's a present value of both lease payments, 5 of them, and the residual value, Okay, and so with the because the balance is different, the interest will be different. We talked about that, but other than that, it's same. So what do we have at the end here is let's see, this at the beginning of 24, this is the beginning of the last year, right? After last payment is made, there is a still bit of a balance, okay? And this balance, so this is the after the last lease payment payment, the remaining liability is $4,545. Okay, and 10%, 455 to round it up a little bit. It's like $1. Let's say 455 of interest is accrued during the year, that's 2024, that's the last year, right? So the liability at the end of 2024 is 5,000 before the payment, not the payment, before the return of the asset. Okay, so when the asset is returned, this 5,000 is not the payment, rather it's the returning of the asset. Okay, and if the returned assets has value less than this amount, then a payment needs to be made. But that's not shown on this guaranteed residual value amortization table. That only shows the residual value. So that's why. So this amortization table has one more row than this one. This one, it's ends at the beginning of the last year. This one has one more row to show what happens at the end of the last year. Okay, so that's okay, so that's an older chat about that. I did not pay attention to the chat. So that's about that. So I think that's good. That's enough for today. Okay, any questions? Okay, so let me just say one more thing. I forgot to do this before I end the class. I'm going to publish the midterm bonus quiz results. And if you have any questions, let's do it. Any question about midterm, any questions about this bonus quiz, let's deal with this week. After this week, we're not going to revisit it. Okay. So, okay. So bye for now. See you guys on Thursday. Bye-bye.